things are starting to break loose a little bit, which is good. Looks like an insurance company is opening up the coffers a little bit and allowing more insurance plans to come through California, especially in the high risk zones, the high fire, high earthquake zones. That's actually good. Probably not what you expect though, because as I read through the article, what gave me the inkling was they're going to do it, but at a higher cost, with or without the insurance commissioner agreeing to it. Farmers has been restricting numbers of new policies to $9,500 new policies per month, which that's not bad. What's going on here, though, is they're opening it up. They're also helping to fortify the California FAIR Plan. And yesterday we spoke a little bit about it, how it's way more expensive. It's 3 times more expensive than standard insurance, but that's because you carry risk to structure. Now, FAIR Plan only covers the structure, not anything inside, meaning your furniture, your appliances, your kids' toys, would also have to be insured on a separate policy, just something to keep in mind. So if you're looking at buying a mountain house, probably going to be paying a little bit more in insurance. And I know a lot of people that are doing that right now. Here's the Eaton fire in Altadena from 2025. It's devastating, right? Like 27,000 homes. It's crazy. Farmer says they'll even begin marketing specifically targeting approximately 300,000 consumers in those distressed areas. That's huge. With fewer companies willing to underwrite coverage, homeowners in vulnerable regions often face limited options and must rely more on the FAIR Plan. So there you go. So what does that mean to us? It means we're going to be paying more insurance, more costs in insurance. The fact that they're opening up more policies to insure people, where State Farm and Allstate are walking away, Farmers is coming in and saying, we'll take the brunt of it, which is okay. And it's fair and it's nice that they're doing that. So thank you, Farmers. Okay, predictions for 2026. This is from Redfin. Mortgage rates will drop to low 6. It already is. We're at 6.3 right now. We got it down to 6.05 a couple months ago. I think what we need, though, is in order to become a happy market where buyers really come back into the market, it needs to be about 5.5%, which is still 0.75% away from where we are today. We're never going to see the 3%, 2.5%. But not until the next COVID or whatever massive Armageddon thing that happens. It could be an economic meltdown. It could be World War III. It could be a lot of different things. But in order for our economy to keep moving, we have to slowly bring down interest rates to adjust to the affordability. Now, affordability is a huge thing. It will improve as wages grow. Now, we're not talking about the minimum wage. We're talking about professional entry to professional to vice president to CEO. All of those wages will continue to grow because as inflation grows, so do wages. They just take a little bit longer for us to catch up. We're not going to see a major uptick like we did in 2020. We're going to see properties rise gradually. Now, this is all across the United States, so 3% is fairly nominal, where we were seeing things go 4 to 6% increase over year. What that means for the Bay Area, for Silicon Valley, doesn't really mean anything. We're kind of landlocked and there's not much more building that can happen here. So what houses we do have, they're going to continue to go up. Probably not the 8 to 12% that we were seeing, but maybe 5 to 6%. So we're going to see prices continue to go up overall. Remember, we're not in a selling season. We're seeing inventory drop, sales drop, pendings drop. Everything is dropping because we're in the middle of winter. The last couple, well, freezing cold. For California standards, rents will rise as demand for apartments rises and supply falls. We're not building enough housing units, period. We haven't been in the last 2 decades. We have an undersupply of housing that's available. We're not building enough to keep up with population growth. So whether you own a house or you rent a house or an apartment, everything's going to get more expensive. If you go to school, become a professional and get paid professionally, you're going to make decent money and you'll be able to afford more. If you don't go to school and you want to do the Elon Musk, don't go to college track, I understand that. It's very tempting, but it's better to have a degree in your hand just because, a lot of people aren't going to start up their own massive tech giant company like PayPal or Amazon. Is a degree worthwhile? In my opinion, it is, mostly because it rounds your rough edges and it gives you a wider spread of knowledge so you can go to work and actually figure out how to piece things together without being told how to work. College rounds you out and makes you a more expandable person. I think every multi-billionaire that dropped out of school was in college, right? And they did drop college because they got a job that made them a ton of money. So out of every Elon Musk, there's probably 500 to 1,000 people that just didn't make it or tried to do a startup and just didn't make it. Affordability crisis will unite policymakers across party lines. That would be great. It might be the tipping point of bringing our parties back together. And if they bring the party lines closer together, that's a good thing. And if it makes it more affordable for all the Americans, that's even better. More Americans will refi and remodel. They will sit in place, not move, remodel their house and make it their own home and live out the rest of their days there. They probably won't be as upwardly mobile, moving every 5 to 7 years as before. So yeah, we need to build more homes. The next big hot regions will be the Great Lakes and New York outskirts, and Zoom towns like Nashville and Austin. But now Nashville is technically a flyover state again because that growth has just kind of dwindled out. They don't have enough economy there. They don't have enough business to make it happen. So we're looking at the shores again to start looking at the booms. And by the way, I saw another video, read another article that talked about the next bounce of technology will be AI and Bitcoin and ETFs. And we're already in place for doing that. And if you don't know anything about that, that's where your next big bumps will be, the next Elon Musk's. And so be prepared, get yourself educated on it. Climate migration will go hyper-local. So places where, there's massive firestorms or hurricanes, etc., that will kind of drive real estate business elsewhere. If you live in a region that has higher propensity for natural hazards, people will tend to not go away. I think that's just pretty basic, right? NAR, National Association of Realtors, will let local MLSs call the shots. Now, the way it is NAR tells us how to proceed and create databases and how to not set commissions, but promote or advertise commissions, etc. Well, now each MLS is going to walk away with a little bit more responsibility, but also there will be more lawsuits on that. It's actually a good thing. MLSlistings.com has been doing that for the last 20 years that I've been around. I notice more and more they're using MLS listings as the technology, but what we're talking about is the Association of Realtors, the local Association of Realtors. And we have Santa Clara County Association of Realtors, but they use MLS listings and they have a voice in how that database is. So we're going to walk away from the realtor.com, the Zillow.com, and the local MLSs will take more responsibility. But I think what we're going to see is more associations going wider and taking more geography so that there's more efficiency in it. I will become a real estate matchmaker, maybe, possibly. I don't see how it works just yet because there's still the brick and mortar. You still have to walk into a house and see if it smells like curry, fish, or dogs. You have to get the touch and feel, and an AI can't open the door for you. Probate and estate sales, I have to tell you that this has been one of the big legs of my business this year. Not just probate and sales, but estate sales, but also your parents moving into adult communities, active adult communities, all the way to retirement communities, to health care facilities. We're specializing in this project. There's a huge need for it. Every day, there's more and more people that are passing away. The boomers are passing away or being put into care facilities, and what to do with the house. That's my specialty. So I can help you with that. If you have any questions about it and how to go through it, who to talk to, how to get your trust and everything legalized, make sure you give me a call so we can talk about it. 90 days on market. This is Eberly Drive, not my listing. $1.6 million, 5 and 3.5 baths, 2,279 square feet. List price decrease. They finally dropped it down. And this is over by Stripe Elementary, Great Oaks Parkway. This is Monterey, Branham Lane. I used to live over here off of Skyway. And let's see, this one has been on market 131 days. And the original list price was 1.9. Now they're down to 1.6. thinking about buying, this is a great buy. Why? Because it's not completely updated. It's not in the best condition. And it's right across the street from a street. And this street right here is East Branham Lane, which is a fairly busy street. So you're going to get a lot of traffic noise, etc. This does have air conditioning, but look, the colors are off, right? It's not neutral. It doesn't attract you. It's a big beam with a chandelier. The kitchen's old, the tile. Yeah, they put in stainless steel, but if you're going to do this right and you want a premium price, I would have muted all the colors, made it all white or light gray or light beige, and then paint the cabinets and put quartz or granite countertop on it just to touch it up. Get rid of that light right there because that thing's just old. It just screams old. And this is a multi-story. This is the bottom floor. This is the main floor. And then the living is up here in the third floor. And I think it's a great floor plan because if you're living on a hill or you're flat, it just makes a lot of sense. There's a lot of stairs involved, but I've sold this floor plan a few times. And this has been built out. They don't have a floor plan. So, proper promotion prevents piss poor performance. This is Santa Rosa Drive in Los Gatos, $5.7 million. This is a bank-owned property, $5.7 million, 5-bedroom, 3.5 bath, 5,800 square feet. It's been on market 19 days. It's also in the fire zone. You can just tell. You can just look. See anything back here, it's going to be in the fire zone, and you still have to get in your car to drive to downtown or Almaden, and it's kind of stuck halfway in between both. But if you like the seclusion, this is a great buy. Probably get it for about $5 million, 4.5 to 5 million. This is an older estate manor type home. It needs to be updated, absolutely. And keep an eye on this one. If you want to know more about it, go to my blog. 40 days on market, we have 215. Everything's dropping just because supply is dropping, the sales are dropping. It just is what it is. We're in the beginning of December and things are going to go slowly right now. People are buckling up for the winter. We're already in the midst of it. We had Thanksgiving, now we have Christmas, Hanukkah, Kwanzaa, and all that, and New Year's, and then everything starts fresh, right? So we're just kind of buckling down, slowing things down, and it is what it is. 90 days on market, we have 93. Those houses are just going to sit on market until they take them off for a month and refresh the listing, or they lower the price and get it sold. We're down to 79. Those in California are 267. Again, that's never been hockey pucked up or hockey